Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist of Wealth Press. Boy, oh boy, today is July 5th. It's the first day back after a long holiday weekend, one of the biggest holiday weeks of the year. And that means a lot of hedge funds, a lot of traders are going to be taking the next few days off. So it's not uncommon for volume to be a little bit on the, on the lower end of the poll, at least till the week gets going. Right now, we're down about 200 points. The fact that we're down in the morning is not such a big deal. I'm a lot more concerned with where the markets are closing instead of where they're opening. Because think about this. Markets are being reactful or reacting based on where Europe and Asia in the morning. But at night, when markets are closed, we're actually seeing where the markets are based on U.S. data. And what we've been seeing the last week or two, last couple of weeks, we've been seeing lower openings and higher closings for the most part. And that's been very, very bullish. That's a good sign. It's in a bear market, you typically see higher openings and lower closings. And now you see lower openings and slightly higher closings, or at least choppiness. That's very, 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 very positive. And again, because today, this is a fragmented week, we were off yesterday because of Independence Day. It's going to take us a few days for volatility and trading action to come back up. Volatility, I'm talking about liquidity. Volatility, we'll talk about that as we get into the ATR indicators. But volatility, it's going to take a little bit of time, and liquidity, it's going to take a little bit of time. Typically, though, volatility is higher when liquidity is lower. And volatility, because when there's lower volatility, there's lower liquidity, there's more chance for markets to move. So it's counterintuitive, but actually as the market progresses, volatility should get a little tighter as well, because volatility and liquidity are related. And if I use them interchangeably, sometimes I do apologize. So the big reports for the week is going to be the FOMC minutes. We're going to see if Feds are having second thoughts about their rate of increases. We've got international trades and goods and services, jobless claims, employment situation. Not the biggest week, but I would say the minutes and the Fed speakers would be the biggest weeks, and international trades and goods and services. Why? Jobless claims and employment data, they've been fairly on par. They haven't been raising any eyebrows lately. They've been a little higher, a little lower, but they've been fairly reasonable. Whereas the FOMC, we want to know what the Feds are thinking right now. And let's get into a little bit of the global economy, and we'll go from there, because we do have a lot to catching up to do. War in Ukraine and its impact on energy supplies are casting a shadow over the global economic outlook at a time when central banks are raising rates to slow inflation. The International Energy Agency said in a report Tuesday that high price for natural gas and supply fears due to the war in Ukraine will crimp economic activity, slowing the growth in demand in coming years. There's just no question about that. A recent report by Fitch Ratings said technical recession in the region using the euro was increasingly likely due to a disruption in gas supplies. And I'm going to tell you guys, energy prices are going to be elevated till this war is done. There's just no ins, ands, or buts about it. There's just too much unforeseeability. China's Commerce Ministry said Tuesday that Vice President Liu spoke with Treasury Secretary Yellen about coordinating economic policy between the two biggest economies and maintaining the stability of supply chain. That is very, very important, very, very meaningful, because we get a lot of goodies from China. And now they're reopening back up, and they want to help make the world hum again. And a lot of it has to do with China, because they're the biggest exporters and the second biggest economy in the world. Minutes from the latest policy meeting of the Federal Reserve, due out Wednesday, could bring a hint on future policy. And that's what I was saying. This is going to be by far the biggest report of the week, especially in light of the fact that a lot of traders are still getting back into their wheelbase. And that means we're going to have low liquidity going into this report, which means the impact of it could be felt even more than usual. Meanwhile, a resurgence in COVID infections in Europe and US. My mom has COVID right now in parts of Asia. Also looming, bringing in threat of a reversion to pandemic precautions. A lot of people are getting COVID. I'm hoping this isn't a start to a new cycle, because that would almost guarantee a recession, or guarantee no recession for the time being, because the Fed may take extraordinary policy. But I don't want to speculate that far into the future, because there's just too much unknown right now. But we got to watch the COVID rates. one of the shining lights that we're seeing right now is the fact that the long bond is no longer going down. The fact that the long bond is actually moving choppiness and moving sideways. And if the long bond goes to the 120, maybe the 125 area, boy, oh boy, I'm going to sell it. Because look, we know rates are going to go higher. We know interest rates are going to go higher. Therefore, we know bonds are going to go lower. But if we can pick up on it, because they're inverse, but if we can get a pullback in the bond market, taking us to the 120, 125, so that we could sell it again, that would be beneficial. The biggest factor that this is showing us is the fact that the Fed may slow down its increase in raising rates. That's what this is showing us. Because if you look at the stock market, you'll notice that the trend has been going just like this. And let me pull up a stock so you could see what I'm talking about. Let me pull up Amazon so you could see exactly what I'm talking about. Just wanted to give you an example to show you how much the bond market is impacting stocks. See this graph right here? Notice down, 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 choppy, choppy, choppy. Look at bond market. Look at Amazon. Looks very similar, doesn't it? How about Crocs? Look at Crocs. Look at the bond market. Look at Crocs. So you see how the consumer stocks, the bond market is going lower, raising rates. As rates go higher, it's putting pressure on the stocks. But bond market going sideways, less pressure on these consumer stocks, on stocks that have a lot of impact as a result of the Fed raising or lowering rates. So you could see here, it's all. I mean, this is not a coincidence. Okay, so the longer the long bond can stay choppy or maybe go higher, the less pressure it would put on the stock market in the long term. Another positive thing that we're seeing is the number of stocks trading above the 200-day moving average. Look at how low we are. And this is any stock above $2 right now. This is not the S&P 500. This is the overall market. This is 2008. This is 2011. This is COVID right here. And look at where we're at. So things are getting a little better. Another positive sign is the fact that small cap stocks are starting to hum. They're actually starting to outperform the broad market. And if you look at it, we are now at pre-COVID levels or right near COVID levels, where the rest of the market, like the S&P, is still kind of up. Individual sectors, you still have defensive sectors, energy, utilities, consumer staples, and healthcare. Now, again, on a monthly basis, you still have these three, but energy's all the way down, whereas energy is still number one on a cumulative basis. And I think till the war's over, energy is going to remain up there. Now, volatility is not going higher, even though the market shrugged last week. And if you look cumulatively, it looks like energy is looking for a bottom here. Utilities are rising. Consumer staples look really good right here, really good. If we can get to the 75 level on XLP, we have a good chance of breaking out. Healthcare is looking good here. Financials are looking really good here. They look like they're bottoming out. Materials looks like it's bottoming out. Industrial and financial both look like they're building a base here. So does real estate. Consumer discretionary is doing exactly what the bond market's doing. Same thing with communication services and technology. So I think while the bond market is moving sideways, these sectors, these speculative sectors right here, the consumer discretionary, communication, and tech, are also going to move sideways. And if that's the case, we may get a little bit of a reprieve from the downside. And if we can go sideways long enough for the economy to get better, that may prolong or extend the period we're in right now and narrowly help us avoid a recession. Now, in terms of the stocks to look at this week, I wanted to give you a nice full update. The stocks that are rallying right now are broader. They're not as energy-based. You've got petroleum, but you got Lamb Western. You got pharmaceuticals. A lot of pharmaceutical companies and industrial companies and consumer staple companies are starting to come up here. So we're getting broader. That's also a very, very good sign. The only negative sign is the energy market is being very squirrely right now, but I'm hoping it'll either, on a cumulative basis, rise again from all the way down to up, or on a cumulative basis, these three are going to start coming down and these three are going to start coming up. That would be ideal. Tomorrow, I'm going to give you individual stocks and sectors to look at, but I wanted you to have a broad market view. I think the market's going to stay choppy or go a little higher, especially with the bond market at these levels. Now, by the way, I'm giving an updated market outlook today at noon today. It's going to be killer. It's free to join the room. The link is below this video. If you're watching on YouTube, go to our YouTube channel, go to our WealthPress YouTube channel. You'll see it in the descriptor. Otherwise, it should be below this video. I'm trying to make sure you start off the trading week and the month off right. And I'm covering top sectors, top trading opportunities with my friend and fellow trader, Tom Busby. And of course, I'll be answering any questions that you have. And I hope to see you guys at noon Eastern time. And again, the link is below in the description if you're watching on YouTube. I'll see you there at noon. Don't be late. It's going to be fun, exciting, and you'll learn a bunch of new stuff. I'll see you there. Bye, guys. Have a great day. Comments, feedback. I want to hear from you. I haven't heard. My email was busted Friday to Saturday. All Saturday, my email was busted. Not till Sunday did I realize that it was messed up. So post comments, give me feedback. I want to know if you guys are benefiting from this and if I'm helping keeping you guys out of trouble. Bye, guys. Take care.